Before I switch over to the bond market, there's kind of one chart that I want to look at that crosses over into both the equity market and the bond market, which is the high yield market. These are the corporate high yields, and what has happened to them, and what it means. I wish I could actually go back further on this than I have on this chart, but I'm going to move this chart in right now for you to see, and this is very significant. So if you look back over here, this is the decline in 2007, 2009 in the stock market. That's that red oval right over there. Look what happened when the breakdown came in high yields. The stock market absolutely collapsed. There is a huge correlation, and we pointed out, recently, that as we saw high yields break and weaken, that that it was likely meaningful, and once they got underneath this level and broke down, well, you can see the massive free fall that's going on. So all of a sudden, the corporations are going to have to pay huge amounts of money to be able to borrow money, and their bonds, of course, are absolutely cratering because they're right now they're in, the question is survivability, and that's what we're seeing. So there are cyclical patterns in here also. This decline coincidentally points out to June or July, which lines up with the stock market right over there. So, and again, that false rally right over here, and then this next decline goes out to November of 2021. So we think that this ABC market that you see right over there is likely, and that is an alignment. Here you can see the stock market's huge break right over here, and how that aligns. The stock market's huge break right over here, and how that also aligns. And there is so much more to come in here. When you look at this is the only 1 or 2 month break right over here. And of course, when it broke off of the high and broke down, it moved over here for almost another year to the downside. So that's what we have in here. It's a situation where high yields are signaling that there is a pretty sickening situation out there for the market. So I wanted you to see that. It's a reflection of yields, and how yields in some areas right now are exploding to the upside, as you can see looking at those type of bonds. So that's overall a look at the stock market. So this is a big picture look now at the U.S. bond market. And I've got a lot of things that I want to look at in here when we look at this. The first chart that I'm going to bring into you is this chart right over here, which is a monthly cyclical chart on yield. This is the 10-year yield, and it has also cyclical harmonics, which are 22 to 44 months. There's a little strange one right in here, as you can see, as the minor cycles didn't quite line up to the lowest point right here, but they're still perfectly synchronized at that point as the harmonic low occurs there. The rest of them are absolutely perfect. Right over here, you can see the rhythms in the market and how clear it is. Now, what we had in here was this downward channel in yields, and we got to the bottom of that right over here at 0.398% on the 10-year. That low right over here looks very much like the low we're going to see, and that is reflective of what I've been talking about in here, of the huge demand for bonds pushing yields up. Now, these green zones that you're looking at, that's where you get the 2 cycles after the nesting moving up, where yields move up. This was more than a year. This was about 7 months off of this one here. This was about close to a year. This one was also close to a year, a little over a year. This one here was over a year. This one here about 8-9 months. And this is the first month off of the bottom. So this, to me, projects to a major bottom in yields, and potentially the end of the bond bull market that is some 40 years old plus. And you can see that big tail right in there, and how yields right now, they're up to 1.08 in the 10-year. And in my opinion, over the coming, year and then maybe longer, going up to, into the 2s, maybe into the 3s in here, as demand for money becomes absolutely severe, and the bond market could be in pretty good trouble. Now, one more image, pretty much the inverse of this, is if I go to the /ZB, which is the 30-year. I wish I could get back further on this one, but the system doesn't have it. Well, there's your 30-year monthly, and that takes you back to 1996. And you can see how it's been trading in that broadening, rising pattern in there. And here is this inverse of that bottom that we had, where 10 years got to 0.39, the 30-year got to 0.84, and left this big tail right here. Now, my opinion is that best case is that it comes back down to the bottom of this, which is about 141, 142, 30 more points on the downside in here, testing the high yield areas that we saw back in 2018. And because I think it is a bond bear market that has begun, it could be far worse than that. So this is reflective of the peak that was made, and look how it got to the top of that. Here's the alignment between this peak and that peak, and here's your upward trend right in there, and this broadening pattern. So 141, 142, sometime out into this 1920 period, 1921 period, maybe 1922, is very, very likely, and that's not going to be a happy situation for the markets. This is again a reflection of the Fed having lost control, and the bond market will price itself based on demand, which is something that the governments have been able to keep from happening. But now that they no longer can control the markets, this could happen. So I think that we're beginning a significant bear market in the bond market. They have achieved the low levels that I had expected, and now I think that that's over with. Now, there will be periods where there's a scramble into bonds, but I think that the trend will establish itself to lower bonds, higher yields, and here as you see. So that is a look at the monthly TNX and the ZB monthly, and a declaration by me that the 40-year bull market in the bond market is dead. So now what we're going to do is we're going to take a look at other monthly charts and give you some sense around this overall pattern in here, and here is the ZNs. So again, you can see the clarity in the cyclical rhythms in here. They're a little more erratic than we had shown some other ones. That was my call for sub 1% yields before the beginning of this year, saying that we'd get it probably sometime out in the summer or fall, but we got it much sooner. So you can see there were 16-month cycles right in here, and then they started to change, and we have 18, 20, 19. That little peak was 11 right over there, and this is 17 right over here. So this week right over here made the peak, and now we're probably likely to fall for the next couple of months. Then after that, you get a rally, and here's where I think that real bear market clicks in the ZNs and comes down and potentially tests this 2018 lows right over here. Nobody would be guessing that this would be the possibility, but we're looking for the present low yields we had in here between Feb and April, and now we already have seen the low yield. So that's basically in place already. So we're going to look for the bond market to decline to that 38.2% right over there. This is the 10-year, which takes you to approximately a 1.46 yield before we get some reprieve in here. So this scramble for capital that you see right over here is likely to last for some additional months in here. So that's a look at the weekly at the monthly in the bond market, having looked at the TNX, the ZBs, and now the ZNs, which are all reflective of lower bond prices. Lower bond prices and higher yields coming. I'm even getting stuck on that one right now. And believe me, I look at these things pretty often, every single hour sometimes. So now what we're going to do, and that's the S&P 500, so we don't want to do that. I've got so many charts up right over here. There's the bond market right there. So now we're going to switch over and look at the bond market on a 10-year weekly and 2-year daily by looking first at the ZNs, and we have people trading ZNs and trading TLTs. I'm not going to show the TLTs right now. Here's your decline right over here. So we said the decline out towards June. There's some nested area over here that occurs late May to early June. So we have been talking about this bond market decline for a long time that goes into this period. Here is approximately 132 on the 10 years, and we think that the bond market is going to move down. We had revised, the low yield was projected out to April 6th and then 622. Well, that April 6th low in yields occurred already, and your June 22nd low is on a rebound right over here, which we think will be a major selling opportunity in the bond market. So this points to a decline out into mid-late May, maybe even early June in the ZNs. When I switch over to the ZBs, you're going to see the same thing, and then we'll do the dailies. And you can see that right over here. Here is your 30-year. This is your harmonic family, which points to these cycles. This is your 10-year coming down here, your 30-year coming down right over here into late May, beginning of June, and a target down over here coming down potentially to about 157. Wow, that's another 14 points on the downside. Your 78.6% is right over here, which is 163. That's kind of a best case that I can see in this declining period coming into late May or early June. Now let's switch back to the ZNs and look at the daily chart, because we want to have our shorter term traders have the information they need. So we have this decline projected out over here. This, if I look at the date over here, that's the 11th of May. That's the 11th of May. So what that says is that this decline that we're having right over here, set up by that, it's an abandoned baby, but it's not showing that way because of the overnight trading in there. That this decline probably comes out to the beginning of April. You get a false rally, and that the next decline out there till May. The sell zone is in here. We're getting a rebound right now. If you get up to about 136.5, up to about 137, I believe that is a very strong selling opportunity in the 10 years. When I switch over here to the ZBs on the daily, let me get ZBs here. And you can see the same type of a pattern. This rally here is very optimistic. There you get a decline over here over the next week, week and a half, and then a rally, and then moving down again. Our projection right over here is to at least 166, potentially down to about 163 over this next week, week and a half, and then moving up. There was a buy zone in here, but we removed it once you get down, as we did over here, as deeply. And that's what we do. If there's a buy zone and it breaks supports, we just simply pull it out of there. It's no longer valid, and now we create a sell zone right in here. So we get a rally up over here in the ZBs, 175 to 170, close to 170.78, close to it. That to us is a big sell. Note that this big upward momentum is starting to roll over. We're about to lose that right now, and we think that we're going to start to get sell signals in here in the bond market when we look at that. So we're looking for much lower prices than a rebound. This will be revised because I actually only think the rebound can come up to about this level right over here. So I'm just going to pull these out because I don't like that anymore. And then after that, it will be moving down again. Now, this shows an earlier bottom and might actually make it out over to here. So declining phase in, you get a bull market, you get a rally, a bullish day or two, I think that it is a screaming sell in the bond market. Right now, we'd say the range right over here up to this level, 175, 176, and down over here about 163. I mean, to me, that looks like a very solid range, and up over into those mid 70s. And I think this is a screaming high probability sell in the bond market.